Okay, welcome to Chapter 9. Chapter 9 is receivables. Receivables are anything that another company or customer or vendor, someone else owes us some money. We've already performed the goods and services, supplied the goods, and now someone owes us some money. So receivables, let's first start off with covering what we have learned about receivables up to this point. If you remember when we were, let's get a, wow, sometimes it just doesn't want to focus. Okay, what we've learned about receivables up to now is, if you remember when we did worked about sales inventory, look at that, all that ink. We talked about returns and discounts. So let's take a look at what a return and discount was. When we had a sale, let's say it was on July 1st, and we sold $1,000 on account, meaning they were going to pay us later. So it'd be $1,000 in AR, and we'd have sales revenue of $1,000, and our AR account would look like this, $1,000. And let's say the customer returned some items to us. Now, for the purposes of this, I'm not going to get into the inventory. We're just going to ignore the inventory and COGS because we're just going to focus on the AR part of it right now. So we would have we'd knock off, let's say they returned $100. We'd knock off $100 off the AR. So now it'd be $900. But rather than mark down the revenue, remember a return would be something called a contra account, a sales return and allowance of $100. And let's say they pay within 10 days. They could get a discount. Remember, we talked about things 2, 10, net 30, meaning you get a 2% discount if you pay within 10 days. They could have actually waited till the 11th. And the balance is due in 30 days. Well, what's 2% on what they owe? Well, 2% of this is going to be $18. So when they get a discount, we're going to go ahead and knock off all of their AR. In other words, just because they're getting a discount, we're going to go ahead and say they've paid their full balance, even if we don't get all the cash. So what ends up happening, part of that cash goes into a sales discount, which is not an expense, but it is a contra revenue. It reduces revenue, and we get the cash difference. And that's what we've learned about AR up to now. How to create it with a sale, how to mark it down if we've got either a return or a discount. Let's continue on with some additional information about accounts receivable that we find out in this chapter. First, if a store has its own store card, like a Target card or a Walmart card or something like that. So this is from the store's point of view. Well, if you buy something on their card, I recently got an Amazon card, so I got to see what the percentage is there. And let's say you buy $200 worth of stuff sometime during the month, let's say on July 1st. And of course, the company's going to record sales revenue. Now, they're not necessarily hoping you don't pay, but if you don't pay by the end of the month, what are they going to do? They're going to charge you, in this case, let's say it's 5% interest. They're going to charge you some interest. So 5% on $200 is going to be $10. So what they're going to do is they're going to, your bill, they're going to increase your bill, right, by $10. Let's see, is this quite level? And they're not going to call it sales revenue. They're going to call it interest revenue because they're charging you interest of $10. Well, how is that different from a credit card? Well, a credit card company basically is, if you've got a store card, the store has to perform its own background check, extend credit, monitor it, and all that sort of stuff. So what do they get for all of that? Well, they get some interest. Well, with a credit card, there's a lot of small businesses, a lot of businesses in general, that don't want to interview every customer and determine whether or not they have got good credit or not. they sort of outsource that to another company, a credit card company. When you fill out your credit card application, it asks you a bunch of stuff. It keeps track of your, your, not your finances, but keeps track of your credit history. And basically it does all the job of kind of extending credit, or AR. And what do? They charge the store for that service. So you've noticed that sometimes if you go buy gas or go buy some of these small mom and pop stores, they want you to pay cash, or they'll give you a better price if you pay cash than if you pay with credit. They'll either give you % back, or they'll just charge you a whole different price. So the credit card company charges a service charge because they're handling the AR and the collection of AR themselves. So let's say we have another $1,000 sale, and let's say the credit card company charges 3%. So from the store that's selling the stuff but is going to accept the credit card, they've got sales revenue of $1,000, but the credit card company takes a service charge of 3%, which is going to be 30, and therefore the store actually gets $970. Now, is it worth it? Most of the times it is worth it. Obviously, you don't want that percentage to be too high, but it's the difference between if you tell a customer cash only, like there's that little pizza place here in town that's cash only. I went in one time, forgot it was cash only, and I had to turn around and walk out because I didn't have any cash on me. They actually offered to give me a tab. When's the last time you ever heard someone giving a tab? Anyway, I didn't want to do that. But the point being is you're okay with the service charge, because sometimes you end up turning away business if you're cash only. And so you'd rather have the $970 and have to pay a $30 service charge than not make the sale at all. Okay, one other sort of thing we want to talk about AR before we get into the main part of the topic for this video is factoring. Sometimes, just in the same situation as 210 net 30, a discount. Well, why do companies do that? Sometimes they're willing to give a little discount to get their cash sooner. If they can get their cash in 10 days rather than 30 days, well, they can turn around and do some things with that cash. Maybe buy more inventory. Maybe they need to pay off employee wages. So sometimes it's worth getting a little less cash to get the cash sooner. And factoring is another one of those things. Let's say, again, we'll just use $1,000. Let's say you have $1,000 in AR, but you don't want to sit around and wait for it to collect it. Well, some companies will buy your receivables. And maybe they'll take a little bit of a service charge off the top. They'll say, we'll buy that $1,000, but we'll give you $950 in case we can't collect some of it. So what do they end up doing is we end up getting rid of our AR, a credit to AR. Again, you'll notice it looks very similar to a credit card because they're basically doing something similar. And here it's 50, and then we get the cash for $950. So this kind of brings us into our main topic. This idea that why would you have a factor, or why would the factoring company charge you a little bit of percentage? Because the ugly fact about AR is that not every customer that you extend credit to is going to actually pay their bill. So how do we do that? In other words, is $1,000 in AR, is that the right number that we want to put on the financial statements, or is some number less? Especially if we know from past history, we have a good idea that it's 5% that don't pay, or it's 10%. Well, hopefully it's not that much. Hopefully it's less. So sometimes customers don't pay, and we need to take that into account when we're valuing AR for the financial statements. Don't pay their AR. So here's an important thing to remember from what we've discussed before. The type of accounting that we study here in the U.S. and in accounting courses is called, if you recall, accrual accounting. And that specifically is resting on one important rule, the revenue recognition rule. And if you remember, revenue recognition states that we only recognize revenue when it is earned. And what do I mean by that? For example, you notice here on all of these sales, we recognize revenue when we've performed the service or we've given them the goods, even though we haven't received the cash. You notice we haven't received the cash. The cash happens later. There are times that we receive the cash first, but we don't recognize revenue. I think we went through and used an example of what if you're a game company and you're taking pre-orders for the game? Well, you get all this money for the pre-orders, but you don't recognize the revenue until you actually provide the game. And that's what we mean by recognize revenue when it's earned. So where do we stick all that cash before we give them the game? Remember, we had an account called unearned revenue, which is, pretty in tune with what we got here. So the other part of the revenue recognition that we talked about, but, did not make a big deal is with every revenue, there's expenses attached to the revenue. And so we've got this other principle called the matching principle. And what that tells us is that we must match all expenses to their revenues, because the definition of an expense is something that helps generate revenue. So you think about rent expense. Well, we needed an office to run our business, or we had wage expense. We needed employees to run the business, or we had COGS, cost of goods sold. That's a special type of expense. That's the inventory we sold people to generate the revenue. But we must match all expenses to revenues. And here's the important part. In the same period. In the same period. Well, what does that mean for us here with AR? Well, AR is a sale, right? Except we just haven't collected cash. But if we believe that over time we've looked at the history of our books over the last couple of years, and we find out maybe 5% of the sales we don't actually collect. People go bankrupt, they just skip out, whatever it is. Now, if we know that AR is not really 1,000, but it's really 950, right? It's something less than that. Well, we need to record that. The problem is we don't know. This is our estimate, right? 5% is just sort of a general long-term trend. It's not the exact amount that's not going to pay us. And sometimes we don't know that. So if we sold $1,000 worth of stuff in January, those AR didn't go bad until sometime later in February or March or April. So what we need to do is we still need to record some sort of expense to say, this is the amount of money that we're not going to collect out of AR, but we have to estimate it. So what do? We have to estimate this amount, and what are we going to call the amount that we don't collect? We're going to call that a bad debt expense. So you see, we have a matching principle. We have an expense. We say we collect where we sold $1,000 and we put it in AR, but some of that AR is not going to happen, and therefore we're going to record a bad debt expense. But just remember, this is an estimate. Let's look at the process of doing this estimate. So the method that we're going to use is called the allowance for uncollectible amounts. And there's going to be a couple of steps to it. So if we have, let's say we have this sale of $1,000, and so we record sales revenue. At the same time, we're going to estimate that 5% of that is not collectible. So what do? We, at the end of the period, if this is all of the sales, we don't do it for each sale. We do it at the end of the period. In other words, we look back on the month and we say, what was our total credit sales? That's what this is, a credit sale. Okay, we know 5% of our credit sales are going to be bad. Not exactly 5%, but approximately. But we're going to go ahead and take the hit right now. So 5% times 1,000 is going to be 50. And so we would write off bad debt expense, because expenses have a normal balance of a debit. It's the opposite of revenue, right? And what are we going to do with this? Well, so we've taken the estimate and we've written it off right away. But those bad debts haven't actually occurred yet. So what do we need? We need some sort of tracking mechanism to say, okay, this is the amount that we think is going to go bad, but we don't know it's going to go bad until we get contacted by lawyers to say the company went out of business or whatnot. In other words, until we've got good information, and then we're going to actually write it off. So until that time, we've got to stick it somewhere. We've got to stick our estimate in some sort of tracking account to say, okay, this is the amount that we have that we're expecting. And this is called allowance for doubtful accounts. So we have this bad debt expense, and now we've got this thing called allowance for doubtful accounts. Now, I said this is done at the end of the period, and we typically call those adjusting journal entries, right? This would be one of those adjusting journal entries that we talked about previously. Well, just pay attention to the fact that, yes, we now have fulfilled our responsibility of writing off or matching an expense in the same period as the revenue, because let's say this is sales all during January, and so on January 31st, we write off the bad debt expense. But you notice that they actually haven't come in yet. They actually haven't gone bad yet. So we have two different types of entries. We have the estimate at the end of the month, and then we have the actual write-off when they occur. And they could occur at any time after January. So let's say this happens March 15th, a month and a half later. We find out from someone that, okay, there's been some, well, let's stick it in February just so that we can kind of keep track of it at the same time. Make this February 15th. We find someone isn't going to pay their bill. And let's say that amount is $30. So some lawyer writes in and says, this company went out of business. They're not going to be paying their bill. So what do? We basically say, these are the amount, we think $50 is going to be bad, but we don't know it until it happens. Well, essentially we're saying, well, now we know $30 of it is bad. So we're waiting for the other 20, right? This is hasn't happened yet. Well, 30 of it has happened. So we take it out of the bucket. So we're still waiting for 20. Well, that's a debit. And what is going to be our credit? Well, we're going to credit AR. You notice up to this point, we haven't done anything with AR. It's as if we're still holding out hope that we're going to collect it. So we never touched AR. But when we finally write it off and say, okay, someone's told us they're not really going to show up or they're not going to pay, well, then we're going to go ahead and reduce AR. We'd already reduced revenue through the expense previously, but we had held off on writing down AR. So at the end of February, we basically said in January we estimated that there would be $50 that wouldn't be paid. So far, 30 of it has happened. We're kind of waiting for 20 more of it to happen. But what's going on is we're at the end of February now, February end, and we need to do this adjusting thing again. So let's say in February, credit sales were, let's say they were $1,200 this time, but we're still talking 5%. So 5% of 1,200 is going to be 60. Now here's the important part. whenever we're using this percentage, and this is one of two methods, this is percentage of AR. What does this number represent? This number represents the new ending balance of, so if we had, let me phrase this differently. Not that we had credit sales. If we had a bunch of sales in February, and the amount that was in AR at the end of February, that's probably how I should phrase it. The amount that was in AR at the end of February was $1,200. We say, well, 5% of that $1,200 is going to be bad. That ends up being the new ending balance. So what do I mean by that? We've done this a couple of times. This has been, where we have a beginning balance and we have an ending balance, and the number that makes it work is going to be our actual journal entry. So this 40 here is going to be our new bad debt expense. Of 40, and it's going to go into ADA, right? Because you can see we've just put 40 into ADA. So just be aware that this number is not the bad debt expense, it's the new ending balance. And then you have to look at the beginning balance, the ending balance, and see what would make it work. Or the ending minus the beginning is the change. And then as you go along, actual write-offs would reduce the ADA. So percentage of AR is one method. There is a little bit more sophisticated method, but it kind of works the same way, and it's called the aging method. And what does that look like? Well, it basically, rather than just saying 5% of all AR is going to be uncollectible, perhaps we have a little bit more detail. So let's take $1,000 for AR at the end of the month. And what we want to do is we want to split that AR into how overdue they are. So let's say there is about $600 that is less than 30 days overdue. And in our experience, in our history, only about 1% of these guys actually are uncollectible. But there are some people that are 31 days to 60 days overdue. And let's say there's, of this $1,000, 300 of it is. And we're saying, okay, once they've gone to that, maybe 20% of them default. And then greater than 60 days, let's say, well, we only have 100 left. Let's say 40% of these people default. And you can do it in bigger increments. You can do 30 days, 31 to 60, 61 to 90, and then greater than 90. But just a simple method here. So 1% of 600 is going to be 6. 20% of 300 is going to be 60. And 40% of 100 is going to be 40. So you would add those up, and that would be 106. So here we just did it as 5% of 1,200. Here we actually looked at how overdue they were and came up with a different number. So rather than 60, it would have been 106 there. So the difference would have been 86. So two methods, percentage of AR, aging method. Both of those give us the ending balance, and then we write the bad debt expense as to whatever the number is that goes in between. The last item here is, let's say it's called a recovery of a write-off. And this is not that big a deal. So let's say a write-off happened for $100. So remember here, this is the write-off format. It is reduce the allowance for doubtful accounts by 100, and then write off the AR by 100. But let's say we heard from their lawyers to say, oh, they're going to go out of business. But let's say they got some new money, and they popped back up and said, nope, we're going to continue doing business, and we want to go ahead and pay off our account. Sorry about that. Well, essentially what we have to do for the recovery is, it's two quick steps here. We have to reverse this. We have to put it back into AR and put it back into ADA. And then because they're offering to go ahead and pay it off, we're going to go ahead and collect that cash. Cash 100 and then AR. Get rid of the AR altogether, but get rid of the AR in that we collected the cash rather than get rid of the AR because we're writing it off. Okay, that is all of the first part of the chapter. The second part won't be as long. It'll probably be about 15 minutes, and it's going to be going over notes receivable primarily. Okay, talk to you soon on the second part.